Good morning, all, and welcome from a warm welcome from JIFIA, and also as well from GANT, who we are actually co-hosting this this morning's training presentation with. I'm just going to give you, I'll give everyone a minute or two to join in. I can see already some attendees joining, but we're just going to give it another 30 seconds to a minute before we get started here. Just bear with us until everybody's managed to join on. Okay, it seems like most people who have registered are already in attendance, as I can see from our attendee list. As I was saying, good morning. I'm delighted to be joined today, not by one, not by two, but by three distinguished speakers. We have collaborators and presenters from XReg today presenting in the way of Anna James and Ernest Lima. And we're also delighted to give a warm welcome to Targ patients from Dolya Consulting, who will be presenting to us, co-presenting to us throughout the course of this morning. So we have two presentations to give you. As I was saying, XReg will be delivering the first session, which will be focusing on the recently adopted, the recently implemented Europeans directive in marketing crypto assets, so that regulatory framework that came into being last September, and we will be hearing specifically there from Anna and Ernest, and they will be giving us with an overview of that specific framework, and also Targ will then follow on, focusing on, well, giving us an introduction, first of all, to GANT, giving us an introduction to Dolya Consulting and their activities here, and also giving us a brief insight into tokenized securities, what they mean, what their problems are, and giving us also an introduction into the pilot regime regulation, which allows for regulated institutions to develop and operate DLT-based infrastructure with going through certain exceptions and applying to certain exemptions to the obviously relevant or regulatory bodies in that respect. So we look forward to hearing from these insights and highlights from these distinguished speakers throughout the course of the morning. Before we get started, I'd just like to draw your attention to a couple of points of housekeeping, if I may. We would normally take Q&A from everyone on the fly, as it were. But I think in order to allow the presentations to just flow a bit better, unless it's something urgent, in which case I'd urge you just to raise your hand through your console, and we'll do our best to answer those questions as we go. We'll have a dedicated Q&A session at the end of both presentation sets, where we will address those questions as they come in by order. So without further ado, I'd like to pass it over to both Anna and Ernest, so they may give us their introduction and their thoughts on MiCA, as it's also known. Over to you guys.
Thank you, Alan. Hi, welcome everyone. As Alan said, we're going to be giving you an overview of the European Commission's digital finance package, which was adopted on the 24th of September last year. As he mentioned, as Alan has mentioned, we'll be breaking up the presentation into two decks. Anna and I will be talking about MiCA generally, and then Targ will be taking over and talking about the pilot regime regulation. In terms of the agenda for the first presentation, we'll be giving a brief introduction on the DFP. We'll be talking about the current EU regulatory environment in relation to crypto assets. Then we'll give an overview of MiCA, talking about what is MiCA generally, what it covers. We'll be talking about some of the specific activities, services, that are being introduced by MiCA. Then there's a couple of slides on what is happening at the moment at an EU level, what changes are being proposed to MiCA. Finally, there's a couple, we'll be going over a number of implications, some considerations that people may need to think about given this new regime that's coming into force in the UK, in the EU. So in terms of XReg, on behalf of XReg, it's myself and I'm Ernest Lima, and Anna James, who's a policy consultant and also our international relations manager. We are from XReg. XReg is a regulatory consultancy firm that specializes in crypto assets, helping both governments and public, other public bodies and private entities in relation to all matters really related to crypto assets generally. We help governments in developing regulatory frameworks for crypto assets. We help private entities operationalize systems, help them with understanding requirements. And we also do a lot of work around AML CFT, not only for crypto asset firms, but also other financial services providers. So the digital finance package, as I mentioned before, was adopted on the 24th of September 2020. It's composed of two strategies, the digital finance strategy and the retail payment strategy, and also a number of legislative measures, the marketing crypto assets regulation, which is the one that we're going to be talking about today, and also the pilot regime regulation, which is the one around market infrastructures. That Targ is going to be talking about. And then there's also a couple of other measures, the Digital Operational Resilience Act and the Consequential Amendments Directive. Although the MiCA and the PRR are specifically, well, PRR actually is also for incumbents, but MiCA is specific for crypto asset firms. The Digital Operational Resilience Act impacts all financial services providers across the EU. What it does is that it introduces some ICT management framework provisions and related requirements to ensure that everybody's taking those risks into account and are operationally resilient. So that measure will impact everyone. And then there's a Consequential Amendments Directive, which aims to clarify certain issues. For example, the legal treatment of crypto assets that qualify as financial instruments. They clarify that that such instruments can be issued by DLT, so that they can use the technology without having to comply with any additional requirements. It will be interesting to see how how Gibraltar implements the Digital Operational Resilience Act, given that it's going to be something that will come into force in the EU post. Obviously, now that we're out of the EU, it will come into force in the future. So we'll need to wait and see how the Gibraltar reacts to that from a crypto asset perspective. There's already provisions in the guidance to be able to cater for those kind of provisions, but more for mainstream financial services, we'll need to see what Gibraltar does. So in terms of the current environment for crypto assets within the European Union, there's no EU-wide framework for crypto assets. MiCA will aims to introduce this and ensure that there is some harmonization across the EU. We have the 5 anti-money laundering directive that came into force already, and it's been implemented in most EU jurisdictions, but not all of them. That has resulted in, at least from an AML perspective, for EU jurisdictions to have a framework for crypto assets, but it is fragmented. Some jurisdictions are aligned to the FATF recommendations, others are not. What it means is that different jurisdictions have taken different approaches. Some have only limited their amendments to AML CFT legislation. Others have a broader regime, like Gibraltar, for example, which we've had for a few years now, is broader than AML. In some jurisdictions, it only applies to firms that are established in that jurisdiction. It doesn't impact anyone that's providing services into the jurisdiction, for example. So MiCA will hopefully bring a much needed consistency, harmonization across the crypto assets space in the EU. There will be some jurisdictions that will need to update the regimes. So if anyone has an existing regime in place, that will be superseded by MiCA. So they will need to replace, update it, or amend it as necessary to make sure that it works and it's consistent with MiCA. So just to give you a brief overview of MiCA. So this is, as you've all probably gathered, the new EU crypto asset law. It aims to provide much needed legal and regulatory certainty in this area. It is quite a comprehensive legal framework. It aims to support innovation, consumer protection, investor protection, ensure that there is financial stability, amongst others. It's an EU regulation, which means that it will have direct effect in the EU jurisdictions, meaning that there's going to be very little discretion in the way that jurisdictions and competent authorities implemented and operationalize this EU regulation, as opposed to a directive where it does give some more flexibility to different member states. So what it does is that it will regulate all crypto assets that are not within the definition of financial instruments. It introduces rules for token issuers and defines what should be contained in white papers for tokens. And it includes requirements for competent authorities to approve white papers also. There are rules on asset reference tokens, otherwise known as stable coins, and also e-money tokens. Some asset reference tokens may be included within the definition of e-money tokens, depending on their features. It also introduces requirements for significant stable coins, and those will come under government control. There is an EU-wide authorization and supervision process and requirements for crypto asset service providers, which Anna will talk about a bit later on. And it also has a requirement for issuers and CASPs to be legal entities, which may have a profound impact on some institutions and some of the issuers. So as I mentioned before, it captures and affects all crypto assets. The definition is very broad. It's a digital representation of value or rights, which may be transferred and stored electronically using DLT or similar technology. It affects, obviously, as I mentioned, issuers of crypto assets, anyone that is offering crypto assets into the EU, and crypto asset service providers. And what it does, it creates a market for crypto assets generally. And on that note, I'll hand over to Anna.
Thank you, Ernest. Good morning, everyone. As Ernest mentioned, MiCA seeks to bring within its scope all crypto assets that are not already within scope of other EU legislation. The regulation defines three main classes of crypto assets. These are a general category that includes all crypto assets, including utility tokens. And then we have asset reference tokens and e-money tokens that are also known as stable coins. Asset reference tokens are those that reference several fiat currencies or other crypto assets or commodities, or a mix of these, so a basket of assets, whereas e-money tokens reference a single fiat currency. Both asset reference tokens and e-money tokens may be deemed to be significant. This will be determined based on certain criteria, such as the size of the customer base or the value of the tokens or other criteria. And whenever one of these assets or tokens is deemed to be significant, its supervision is transferred to the European Banking Authority. So the European Banking Authority will be in charge of supervising and monitoring their activities and the way they grow and other. There's some key requirements for all issuers of any type of crypto assets. The main one is that in all cases, they need to be incorporated as a legal entity. So natural persons will not be able to issue any type of crypto assets in the EU. In all cases, a white paper needs to be drafted and published. Some need to be approved, others don't. With the white paper, any marketing communications will also need to be notified or approved by the competent authority. And in all cases, the regulator will be able to intervene. So if the regulator deems that anything in the white paper may need changing, it can request this, or it can halt or suspend issuances or even publish communications wherever an issuer is in breach of its requirements. We will now talk a little bit more about the specifics about stable coins. So in both cases, these issuers will need to be authorized. Asset reference tokens, issuers of asset reference tokens will need to seek authorization in the jurisdiction where they're based. So they will have to be a legal entity established in an EEA country, and they will have to be authorized there. Their white paper also needs to be approved. So if it's a new issuer of asset reference tokens, as it goes through the authorization process, its white paper would be approved then. They will need to grant minimum rights to holders, and they will have to comply with other requirements, such as having wind down plans in place and certain capital requirements, among other. Issuers of e-money tokens in all cases have to be credit institutions or e-money institutions. So unless already authorized as one of these entities, they're not able to issue these types of tokens. E-money tokens have been deemed to be e-money, so they need to comply with most of the requirements already contained in the e-money directive, and they need to grant, they need to be issued upon receipt of funds, and they need to be redeemable at par. So if an e-money token is referencing £1, it must be redeemable upon request at that value. As I already mentioned, both asset reference tokens and e-money tokens may be deemed significant. If they are, they will be subject to more onerous requirements, including higher capital requirements, some specific liquidity and interoperability requirements, and they will be supervised by the European Banking Authority. A crypto asset service provider. So MiCA will cover issuers of crypto assets and service providers providing any of the defined services within the regulation. The definition of crypto asset service providers is quite broad and covers everyone that is providing by way of business any of these services. The crypto asset services defined in MiCA are very much in line with the investment services defined under MiFID, and they're also aligned with the FATF's virtual asset services. The crypto asset services include custody and administration, which is effectively safekeeping or controlling crypto assets or the means of access to these. So wallet providers would fall under this category. Operating a trading platform, so managing a platform where buyers and sellers can interact and buy and sell different crypto assets. Exchange services between crypto and fiat and crypto and crypto. Order execution, reception, and transmission of orders to buy and sell crypto assets. Placement of crypto assets, which is the marketing of either newly issued crypto assets or crypto assets that haven't yet been admitted to trading in a trading platform and are sold to a specific group of purchasers and not offered to the public. And giving advice is, this service is not included in the FATF's list of virtual asset services, and it covers personalized or specific advice that is given either at the initiative of the crypto asset service provider or at the request of the customer. So generalized advice is not covered under this service. Key requirements similar to issuers, crypto asset service providers must be incorporated as a legal entity. So either a company or a foundation or some other kind of legal arrangement. They must be authorized as investment services, as investment firms in the EEA. They must be authorized as crypto asset service providers. They will be able to provide payment services with the crypto assets that they deal with, but to do so, they will also require authorization as a payment institution under the Payment Services Directive, and they will be subject to prudential and organizational requirements, including that their governance body is, that the individuals are fit and proper, and that they have business continuity plans in place, among other things. Worth noting that banks and investment firms that are already authorized to conduct similar services, even though not with crypto assets, will not require to go through the full authorization process that a new service provider would have to go through. They will still need to comply with some operational requirements in MiCA, but they will not be required to submit the level of information that new players will have to provide. And I'll just briefly let you know where MiCA is at. So since it was published in September 2020, it's been undergoing the European legislative process. The rapporteur, the Parliament rapporteur that is taking this piece of legislation through the process, published some proposed amendments to the text about a month ago, at the end of February. And some of the, well, it was only 14 proposed amendments, so we're expecting many more to be published. The Econ committee has until the 19th of April to publish its proposed amendments. I think the most important of these amendments is that the European Central Bank is being given a lot more of a say when it comes to the authorization of issuers of asset reference tokens or the issuance of specific asset reference tokens. As MiCA was, as MiCA is, as the draft that is currently published, when issuers of asset reference tokens are authorized, it's the national competent authority that makes the determination of whether they can be authorized or not. The process does require the national competent authority to send its draft decision and the application documents to the EBA, ESMA, and the European Central Bank, and also a central bank if the currency in that member state is not the euro. And these institutions would then issue a non-binding opinion to the national competent authority, which it had to consider before making its final determination, but it was a non-binding opinion. The proposed amendments are trying to change this so that the opinion by the ECB is now binding. So if for monetary sovereignty or financial stability reasons, the ECB decides that it wouldn't be safe to allow a certain issuer to be authorized, then that will be the final say. With regards to e-money tokens, as I mentioned, these can only be issued by banks or e-money institutions, and their white papers for the issuance of e-money tokens did not require a pre-approval the way that white papers for asset reference tokens did. But now it seems like they will require approval on the same grounds of financial stability and monetary sovereignty. Some of the other changes include changes to definitions. So for example, the definition of DLT they've removed the word encryption there as it was limiting, and it wouldn't extend to tokens that are based on Ethereum, for example. Crypto asset service providers are likely to also need to have in place wind down plans, the same way that issuers of asset reference tokens and of course banks and e-money institutions need to. And another change is that crypto asset service providers that transfer crypto assets for payment purposes will have to have the systems in place to be able to trace the movement of these crypto assets in the European Economic Area and in or from the EEA. I'll hand back to Ernest. He'll tell you a little bit more about the implications and potential impacts.
Thank you, Anna. I've got a couple of slides on some of the implications and some key considerations as a result of MiCA. So first of all, if anyone's dealing with a financial instrument, it is still a financial instrument. There's no impact really to that regime in any way. In terms of offering or providing offering crypto assets or providing any crypto asset service in the EU, if anyone is for example marketing or offering tokens into the EU, they would need to consider the impact that MiCA will have on them, and whether or not they need to go through any process with any competent authority. So what it does is that it impacts the offering of services within the EU and also into the EU. As I mentioned before, MiCA is a very comprehensive regime. The idea is that it wants to capture everything in any way it can. There's unlikely to be many gray areas. There's always gray areas with the legislation, but the idea is to not leave many stones unturned, which is in line with the FATF guidance and recommendations. So it's either a crypto asset or a financial instrument, and depending on what products you're dealing with, you need to consider which regime would apply to you. In terms of the requirement for there to be a legal entity, that is something that's quite important, because it not only impacts the crypto asset service providers, but also the issuers. There is a need for someone along the way to be accountable for the actions of that legal entity. So this has some implications for decentralized finance in particular, and there's been quite a lot of discussion around that. Will MiCA be able to accommodate decentralized finance? There is obviously some key considerations around the requirement to have the legal entity, as we mentioned already. Where issuance is fully decentralized, there's normally no identifiable issuer. So how can they comply with those requirements? Some challenges which may make it difficult for decentralized issuers in particular to comply with MiCA. and other decentralized finance platforms, which may have some hurdles to overcome, and see whether or not they can actually fit their business model to be able to comply with MiCA. Final point there is MiCA the model framework to follow. It's I think the first fully comprehensive framework that tries to capture everything that's been published. It inevitably will have an impact across the world, and some jurisdictions will look at some of the provisions, some of the requirements, and see how they can fit that into their regimes. So that's it's going to be interesting to see the reaction by other jurisdictions, and see how much they follow what MiCA is proposing. And our final slide, some other considerations. There is obviously some friction between financial instruments and crypto assets, in the sense that in some jurisdictions they've got broader definitions of financial instruments. There is the potential overlap and consideration of whether some crypto assets fall within the definition of financial instruments, which means that there's potentially different views that are being taken by different EU member states. Hopefully that is something that will be clarified before the regime comes into force, by the issuance of further guidance or making further changes to some definitions to make sure that that is made absolutely clear. Otherwise, there's going to be some conflicts, and some jurisdictions may need to authorize crypto asset activities under MiFID, for example, and others not. And then what does that mean for passporting, for example? So that's something that will bring about uncertainty unless it's resolved. In terms of privacy, crypto assets with privacy features will not be able to be admitted to trading by CASPs. So tokens that deter any user identification and transaction history are prohibited. There are no transitional arrangements for asset reference tokens, meaning that as soon as the legislation comes into force at an EU level, they will need to be authorized, which will present some challenges unless regulators start gearing up for this well ahead of time and start the registration process before the legislation comes into force. There may be an issue there for existing issuers of asset reference tokens. In terms of raising capital, there's no discretion like in the Prospectus Regulation for the thresholds. It's 1 million as opposed to 8 million. So there's going to be it's going to be harder for some startups to raise capital in relation to crypto, and question whether or not it is a level playing field. Anna's already mentioned that banks and investment firms will not require authorization as a CASP. There's obviously good reason for that. Only banks and e-money institutions can issue e-money tokens, so it doesn't open up the market for anyone else to be able to do that. And there's some questions around the pilot regime, which I'm sure Targ will touch upon now, which is some of the exemptions are only targeted at incumbents. So there's a question whether or not it should be opened up to other providers that are not currently in the space.
Right.
And unless anyone has any further questions at this stage, I'll hand over to Alan and then Targ.
Yeah, Ernest, thank you very much. I'm not too sure whether you can actually see the Q&A, but it's quite fitting because I was just going to draw everyone's attention to the fact that we do have a Q&A open, and indeed we've got one question coming from Justina Gazinska. So Justina's asking, how does MiCA fit or otherwise into the existing legislative framework here in Gibraltar, and in particular the DLT framework? I'm not too sure whether that's a question you would like to take now and answer that before we hand over to Targ. Do you think that would make sense?
I'm very happy to. So the DLT framework in Gibraltar, as we all know, is principles based. So I don't think there would be too much of an issue to be able to fit the MiCA requirements into Gibraltar and into the Gibraltar regime, I think there will be some changes inevitably that will need to be made to Gibraltar in the way that it approaches some of the high-level requirements, and we may need to have some more specific provisions incorporated into the legislation or by way of further guidance. But at the moment, I think Gibraltar is in a good place in that it is a very open principles-based regime, which I think can accommodate MiCA without too many issues.
Right. Thank you very much, Ernest. As I was mentioning, we have a Q&A open. I'm indeed certain, if not hopeful, that we will get further Q&As or questions coming through into that thread. So please do feed us through, and we will do our best to answer those at the end of the session today. Before we hand over to Targ, I'd just like to say I think we have your attention for another 25 minutes or so. So we'll do our best to get through that in that time. So over to you, Targ, if you're ready, and you can take us through your presentation deck now.
Absolutely. Thank you very much indeed. So everyone should now see the flapping European flag. So as mentioned, thank you very much, Ernest and Anna, for the MiCA overview. So obviously I'm here to talk about the pilot regime. So it's the EU pilot regime for market infrastructures based on distributed ledger technology. So firstly, why am I here and speaking to you? So I am privileged to be on the executive committee of the Gibraltar Association of New Technologies. It's an industry body that was founded in 2018 to represent and support Gibraltar with distributed ledger technology, its innovative approach to that, and also other new technologies. So we do a lot of work with between policymakers and the private sector, so helping to shape the regulation that obviously XReg and I will be talking about today, and also involved in things like training and networking. So if you have any interest in or exposure to innovative technologies or anything related to DLT, if you're not already, I'd really encourage you to get involved. It's a really fantastic community in Gibraltar, and it's going to be a very lively few years ahead of us. As mentioned, I am one of the 4 founding partners of Dolya Consulting. It explains on our website, but Dolya is a Slavic deity who represents good fortune being sown through people's lives. So we're a boutique consulting practice. We offer regulatory compliance and business development and strategy, associated strategy services to clients engaged in regulated activities, so working in regulated industries. And we're involved in business development, change, and establishment in those areas. So I have 18 years of industry experience. My specialisms are financial markets, international regulation, DLT and blockchain, fintech, regtech, and compliance. So, tokenized securities, what are they, and why may they matter to you? So there's a lot of terminology in the token space. I won't really go into the deep nuance of it, but there are 2 components I'll talk about. So the first are security tokens. So these would be native crypto assets, so issued on the blockchain with characteristics that would bring them within the definition and therefore the regulatory perimeter of being financial instruments. Whereas tokenized securities more broadly tends to refer to traditional financial instruments that have been dematerialized or are otherwise recorded and settled using DLT or blockchain. And what we're going to talk about here will really affect both of these. So the key components of these are that they facilitate T+0 or instantaneous settlement. Obviously, delays can be put into that for various purposes like liquidity management. You can have non-intermediated accounts, so there's not a need for a separate custodian and the different layers that you normally have in security accounts and holdings. And there's a great deal of potential for automation and interoperability. So with blockchains, you can have those talking to one another, and you can automate a lot of flows, including with smart contracts, things like corporate actions, which obviously brings a huge amount of efficiency. So when comparing this to the traditional securities market, you have a stack of costs in that profile. There are participation costs because of the inefficiencies. The securities market obviously evolved over a very long period of time in a fairly organic way, and therefore it really isn't as efficient as something that's being designed with modern technologies. So there's obviously custody costs, clearing costs, and where you're clearing and you have that period of risk between execution and settlement, there may be collateral pledged, and if that collateral is not bankruptcy remote, you need to hold capital on your balance sheet against that collateral. There was some analysis done by a company called XReg in 2014, which just is a fairly good graphical highlight of the comparative costs. So the darker bars at the bottom are showing trading costs, and then the post-trading costs, where all of this additional infrastructure comes into play, is highlighted above. On the right side of the screen, it's actually been truncated because it goes to a much larger scale. So the key thing with traditional securities, it's T+2 or even greater. You have multiple intermediaries, which obviously through all of that infrastructure, you're acquiring cost. And you have fragmented markets. So obviously dematerialized securities may be issued on multiple venues. You can ostensibly transfer them between listing venues, but they tend to go through gateways where you have to rematerialize and then again dematerialize the securities. So there's a huge cost efficiency that can be gained by tokenizing those securities. So navigating existing regulatory frameworks. Many of you will be familiar with trading venues under MiFID II. So MiFID II introduced, like, sort of extended the protections under, or the controls under MiFID I on regulated markets to other types of trading venues, so organized trading facilities and multilateral trading facilities. You also then have critically central securities depositories in the securities ecosystem. And the most relevant point to tokenized securities are firstly Article 3.2 of CSDR, so it's the Central Securities Depositories Regulation, which states that any transferable security that's traded on a trading venue, so that's any of those three venues listed on the left, needs to be recorded in book entry form in a CSD. So that transaction, that top level ownership, which is often a custodian, the transaction needs to be recorded at a regulated CSD. And looking at Article 2.1 of CSDR, what is a CSD? How do you get regulated? The key requirement is that you operate a security settlement system, and the requirements of that are defined in the Settlement Finality Directive. And they will also provide at least one other core service. Now, so it is possible to use tokenized securities. Obviously, the benefit, as many of you know, of a blockchain is that it is a ledger. You're recording that book entry, and as I mentioned, it can be a direct holding. But in order to fit within the existing regulatory framework, you need, in the current world, to implement some, you need to jump through some hoops, and you need to implement some specific infrastructure to effectively tick those boxes and say, I've met these requirements. So you've got that recorded on a ledger, but then you've got to duplicate it at a CSD and find one that's willing to work with the technology and execute that sort of T+0 recording model. So you've got that whole sort of stack of financial instrument regulation to consider in the current world. So obviously the Prospectus Regulation, and you need to obviously consider how you reflect the specific characteristics of your tokenized security in a prospectus. There's obviously MiFID II, where the instrument really fits within those definitions. With MiFIR, obviously the reporting is going to be required. The instrument would need an ISIN, for example, and there's not real clarity in how you differentiate a tokenized instrument in the reporting frameworks that are in MiFIR. There's obviously CSDR, which I've touched on, and a whole raft of requirements for a CSD. And also, obviously, the market abuse regulation needs to be considered. The real issue is that all of these regulations came about in the wake of the financial crisis and sort of restructuring the markets, but they were written before blockchain had really taken a hold, and they didn't really consider a world where that traditional market structure would exist. So we're really at that sort of friction point at the moment between financial innovation and the regulatory framework that exists. So an overview of the pilot regime. So what were the EU trying to achieve with this? So firstly, they wanted to develop a secondary market for tokenized financial instruments. Within that, they wanted to promote the use of DLT for both trading and post-trading solutions. They want to enable market participants and regulators to gain experience and opportunities, and also the issues of using DLT for these purposes. So they're starting it out with the pilot regime, which is effectively an extended sandbox approach. But they still want to obviously ensure financial stability, investor protection, and market integrity, which are all very valid aims. So the way this is manifested is that under this, there are these, as mentioned by XReg earlier, there are two new types of market infrastructure, a DLT MTF and a DLT CSD. So DLT MTF, only authorized investment firms and market operators are eligible to apply. So you already need to be a regulated entity in this field. There's potential exemption from that requirement to have book entry record keeping on a CSD. So you don't have to replicate, but subject to various conditions. And there's a proposal to amend MiFID II. So in the current world, you can't have an individual who's a member of an MTF. And that's because as a trading venue, you need to have certain financial and operational capabilities to deal with things like a default event. But that with the advent of instantaneous settlement, there's an ability then to have direct to retail account holdings at an MTF, again, subject to those conditions. And then there's a DLT CSD. So again, only authorized existing CSDs are eligible to apply. They're able to request exemptions from aspects of CSDR and the Settlement Finality Directive, so around being a specific security settlement system and meeting those requirements. And that would allow natural and legal persons to be participants. So again, you can have those direct account holdings. And instead of using central bank money to settle, so in Europe, obviously, they have the Target 2 system and Target 2 securities, it would allow e-money tokens to be used for that settlement. There are limitations. So any shares of issuers need to have a market cap of less than $200 million in the proposed pilot regime. Bond issuance size needs to be less than 500 million euros. No sovereign bonds were proposed to be allowed, and there's a total limit on the total amount recorded on any individual DLT market infrastructure of 2.5 billion. These infrastructures would need to be very, very unique, so you couldn't have multiple chains being operated by the same firm. It would have to be very limited to a specific operation. And every firm, there's a raft of requirements, but they need to have an exit strategy, a transition strategy, sorry. So at 2.25 billion euros of recorded value, they need to trigger that transition strategy to wind down the blockchain. So there's been a very, very conservative approach to the use of DLT for recording this kind of these securities. So there are some proposed amendments, as Ernest and Anna mentioned. There's been on the 9th of March, Johan van Overveld, who is the rapporteur for the Committee on Economic and Monetary Affairs in Europe, proposed some amendments. So as I said, it's a prolonged sandbox approach. He's proposed that they reduce the timeline from 6 years, again, further being further conservative, with an early exit assessment after 3 years, whereby there would need to be an assessment, do we continue this and extend it, but a final assessment at 5 years. It's supposed to be a level playing field. However, as mentioned, the only existing regulated entities in these fields are able to apply. This is obviously a challenge, and in fact, a lot of the firms who are at the leading edge of this technology are not yet involved in the space. So that's certainly quite a major challenge in terms of being a level playing field. They've also proposed equal requirements and abilities, which is somewhat strange. So the proposal is obviously where MTFs are able to, or DLT MTFs are able to operate a ledger to create that level playing field within the elite club of existing regulated entities. They've proposed that CSDs be able to operate an MTF as well within the DLT framework. There's a limitation on instruments. So the rapporteur has actually proposed allowing sovereign debt, which is reasonable. It doesn't seem there's any specific reason to prohibit sovereign debt, but there are obviously no other tokenized financial instruments. So even with sovereign debt, there are no other money market instruments, units in collective investment undertakings, or derivatives or emissions allowances. Obviously, derivatives would be a whole other layer of complexity. And then there are those issuance limitations. So what I mentioned on the previous slide, there's actually a proposal to reduce market cap for equities down to a maximum of 50 million euros, and that 500 million bond issuance down to a maximum of 50 million euros again. So really even taking a much more conservative approach. So within this, there are some opportunities for Gibraltar. We can take some parallel approaches. And so obviously there was a question earlier in discussion around the development of the DLT regime in Gibraltar. So firstly, timing. We can move faster than the co-decisions. In Europe, obviously, with the ordinary legislative procedure, where the Council and the Parliament need to agree to regulatory frameworks. Gibraltar is obviously able to be much more dynamic and fast-moving than that. We can take a stronger stance. So we are obviously doing a lot of assessment, which is very involved in the DLT arena, and so we can look at where the shortcomings are within this regime, as well as with MiCA, and improve on those and be able to get in there slightly quicker. Also taking balance, so a genuinely technology agnostic approach and a real level playing field. There's a bit of a conundrum with obviously the use of DLT. When you're offering regulated financial instruments, you have legal responsibilities in terms of your settlement. You're entering into a legal contract with the other party, and it's somewhat irrelevant how you satisfy those obligations. If you use a specific platform, a specific database technology, a specific hardware in a financial institution, it doesn't really need to be confirmed by the regulator that that's okay. And so there's certainly an argument to be had in terms of obviously the need for testing and assurance, and you are subject to obligations, but it is questionable the extent to which there needs to be an excessive degree of caution with respect to the use of DLT, providing it is adequately tested and sufficiently robust. Decentralization. So as mentioned by Anna and Ernest in terms of MiCA, it doesn't really permit for decentralization. And there's been a lot of discussion, and again, encourage others to get involved in GANT. There's a lot of really interesting discussion around the potential for a kind of regulatory framework for decentralization, where a lot of smart contract automation is in place. So part of that may be the auditing of protocols before they're allowed on the market. There is plenty of regulatory precedent that could be applied there. So MiFID II, for example, introduced controls around high frequency and algorithmic trading. There are requirements for testing in non-live environments, assurance around the performance that it's not going to, an algorithm's not going to undertake market abusive practices, etc. And so conceptually, there would be an ability to have a regulated service that would be able to perform an audit on a protocol before sending it live to ensure that there's not a backdoor where someone's going to suck the money out, or it's just not going to perform as intended, and also other sorts of infrastructure around areas of compliance, etc. So there's ways we can be innovative and work with the industry to assess how we can accommodate those areas. DeFi is certainly something that's been growing in interest recently, and really we're just building on really strong foundations that Gibraltar has in the DLT space. There's a very strong community here. Some of the most advanced firms in the space have connections in or are based in Gibraltar, and so we are able to use that, and particularly with GANT as an industry body, to pool that expertise and bring together something that is able to exceed what Europe are proposing and continue to keep us at the leading edge in DLT and blockchain. So that concludes my slide deck. Thank you very much. Happy to discuss and answer any questions.
Great, thank you very much, Targ. In fact, we do have a few questions coming in. First one, I think, is more of a comment rather than a question from Joey, and I think he was drawing your attention to the fact that the equivalence regime that is being considered for third countries gives a transposition period of around about 36 months at the moment. I'm not too sure whether that is fully within your understanding or not. Would that be right? And that's for Targ.
Oh, sorry.
I think that comment came in when you were speaking.
It's more. I think he was clarifying one of the points that I made, and the fact that there will be an equivalence regime being introduced under MiCA, which will potentially allow for Gibraltar to become an equivalent jurisdiction and have access into the EU in the future. So yeah, good point.
Yeah, it's very, very similar to equivalence that's under, again, MiFID II introduced the third country provisions for access. There are limitations on that though. So for example, under MiFID, you can only access professional clients within Europe by meeting the equivalence requirement. The issue with equivalence is also that there are objective criteria to meet, but then it's also a somewhat political process because there needs to be agreement. And so obviously that other tensions can come into play. But to access retail investors or even elective professionals, so those that don't meet the criteria, you need a regulated branch in a member state. But it's very likely that there will be equivalence requirements in those evolving regulatory frameworks. The other thing to consider is that other jurisdictions will do the same. So the US, for example, in derivatives regulation has equivalence requirements under Title 7 of Dodd-Frank, and there were actually quite a lot of tensions in terms of recognizing equivalence between the US and Europe, which if that had not been met would have been quite impactful to the markets.
Great,
yeah,
thank you for...
It's definitely something for JIB to carefully consider.
Great, thank you. I think we have almost a housekeeping question coming through as well, which is whether these slides are going to be available. I certainly address that in my closing comments. I do think that they will be. But we have a question also from Benji, and Benji is asking us whether there are any MiCA provisions that we need to comply with at this point in time in connection with the marketing, in particular, of ICOs to EU-based buyers. I'm not too sure who would be best positioned to take that. Perhaps Ernest again.
I wouldn't say that there are any specific MiCA provisions, because obviously MiCA has not come into force yet. But they would need to understand the position in the different EU jurisdictions where they want to market ICOs, and whether or not there are any requirements in those particular jurisdictions. And as I mentioned before, the position is quite fragmented at the moment, which means that they will need to know whether or not there is a potential issue with marketing ICOs in particular jurisdictions at the moment.
Great, thank you very much, Ernest. We have a question also from Joey. Joey's been quite active on the Q&A, so there's a couple of further questions from him as well. He's asking, that was actually pointing out that MiCA brings services that are built on DLT technology within the scope of financial services regulation. And he's asking on that particular point, does that really maintain tech neutrality?
I think that lines up with my comment a moment ago, that personally, there's a lot of debate that can be had on that. But my personal view has very much always been different financial institutions. If we look at the existing markets, have different hardware, different software, different databases. There are protocols that have been developed, like the FIX protocol, and obviously things like the SWIFT network, so that banks can communicate and create straight-through processing and talk to one another. If I'm setting up a bank, I don't need to tell the regulator whether I'm using IBM or Dell hardware, or if I'm using Wall Street Systems or Murex. The point is, I need to satisfy my obligations under a raft of regulations, which there's great clarity on that. Providing I do so, I don't really understand why there should be a concern about the use of DLT. It just provides a lot of opportunity for efficiency, but certainly needs to be there needs to be that assurance that it's robust and performs as intended.
Great, thank you very much from Targ. At this point in time, I don't think we have any further open questions. I'm not too sure whether anyone else may want to quickly submit another one as we draw close to this presentation. But in the meantime, I'd just like to say a very a very sincere thanks to GANT for co-hosting this webinar training with JIFIA. So on behalf of JIFIA, thank you to GANT. As far as I'm aware, this is one of the first co-hosted presentations and webinars that we've done. I very much look forward to having the opportunity to do another one, should that be suitable in the time. I think we've got a hand up first. Let's see, Russell is asking a question. I'm not too sure if Russell, I can see your hand is up. If you'd like to just type your question in. No, he seems to have lowered his hand now. Russell is asking that we have a number of funds, in fact, pointing out that we have a number of funds, largely EIFs, which are accepting in-specie crypto subscriptions, and that fund administrators are administering. So thank you for pointing that out, Russell. I'm not too sure whether you have a further question on that, but I can't actually, unfortunately, I can't share your speaker at this point in time. No. Okay, I do apologize, Russell, if we haven't got the last part of your question, but I am conscious of the time. So as I was saying, thank you very much to GANT for their collaboration here, and we do look forward to future collaborations. I'd definitely like to thank all panelists for their contributions this morning. So thank you, Ernest, thank you, Anna from XReg, and thank you, Targ from Dolya for joining us. It's been a pleasure to have you on our webinar series this morning. We have future series on JIFIA coming out, so please I refer you to our website for those, or just watch out for us on your inbox as we announce what future trainings will be coming your way. Just to finalize, as I was saying, I do think that these presentations that we've had, the benefit of receiving this morning will be made available to you if you so wish, or just reach out to us and we'll do our best to share those with you. I do know that certainly this webinar has been recorded this morning, so if you want to play it back, or you have any colleagues who you think would benefit from watching the replay, and once again, just reach out to us. We'll be happy to register you after this event, and you can get a link to watch the webinar replay in your own time when it's probably suits best. Okay, well, thank you once again all very much, and I'd like just to wish you a good day, and I look forward to seeing you all soon.
Thank you so much for having me.
Thank you,
guys.
Thanks a
Okay,
lot.
great. Thank you. Bye-bye.
Have a great day. Bye.